Welcome back, everyone. We're diving into something a lot of you have been asking about, money and banking. But not just the surface stuff.
Yeah.
We're going deep,
Yeah.
really uncovering how money is actually created.
Yeah.
The history, the surprising history behind it,
Yeah.
and how it all impacts your daily life.
Yeah, for sure.
We've got a few guides with us today. We've got Money and Banking by Michael K. Salimi.
Great textbook.
That's right.
Classic.
And The Deficit Myth by Stephanie Kelton.
Another good one.
And then this one's interesting. This is a transcript from an unnamed source
Interesting. Okay.
that really challenges some conventional thinking.
All right.
So I'm excited to dive in.
It's fascinating, isn't it?
Yeah.
How we use money every day, but we rarely stop to think about where it comes from or what truly gives it value.
That's right.
Yeah.
So let's start there. What eyes money?
All right.
Salimi, he lays out the classic definition, a medium of exchange, right?
Makes sense.
But our unnamed source takes it a step further, emphasizing that money is ultimately a social agreement.
Oh, interesting.
It's about a shared belief in its value, whether it's, coins, paper.
Or even just numbers on a screen these days.
Right, exactly.
It's all about that shared belief.
Yeah, what's interesting is that shared belief has evolved over time.
Oh, absolutely.
Think about the barter system.
Yeah, trading a chicken for a basket of apples.
Yeah, exactly.
Salimi points out how cumbersome that was.
Right.
So inefficient.
And then came, receipts for deposited goods.
Right, like a claim check or something.
Exactly,
Yeah.
which became a form of money themselves.
That's interesting.
Right. It's like a step toward a more abstract system.
Definitely. Moving away from the physical goods themselves.
And those receipts paved the way for gold-backed paper money.
Right. Still tied to something tangible. But much easier to carry around than a sack of gold.
Exactly.
Yeah.
But the real mind bender is how we transition to where we are now, where money's value is largely based on faith.
And government decree, right?
Right, exactly.
That's a big leap.
It makes you wonder what innovations lie ahead for money.
Now, what's next?
Right.
Who knows?
But before we go there,
Yeah.
there's this surprising claim from our unnamed source.
Okay.
They say most money today
Yeah.
is created not by governments, but by commercial banks
Really?
through loans.
Wait, banks create money?
That's what they're saying.
That doesn't sound right.
It's not as crazy as it sounds.
Okay, I'm listening.
So they cite Paul Tucker, right?
That-
Former deputy governor of the Bank of England,
Right.
who stated that by far the largest role in creating money is played by the banking sector.
Huh. Interesting quote.
And to understand this,
Yeah.
we need to look at Salimi's explanation of fractional reserve banking.
Okay, break that down for me.
All right, so banks are required to hold only a fraction of their deposits as reserves.
Okay.
The rest they can lend out.
Okay.
And each loan actually creates new money.
So if I deposit $100,
Yeah.
the bank keeps, say, $10
Right.
and lends out $90.
Exactly.
Then someone else deposits that $90.
Uh-huh.
The bank keeps $9, lends out $81, and so on.
Yeah, like a chain reaction.
Exactly.
It's how the money supply grows.
Wow, that's pretty wild.
Right.
Yeah.
And this system, as our unnamed source points out,
Yeah.
can be quite profitable for banks,
Right.
but it also raises concerns about stability and control.
Yeah, I can see that.
Salimi gives some striking numbers here.
Oh.
In 2005,
Okay.
U.S. banks held $5.7 trillion in deposits,
Wow.
but only $311 billion in cash.
That's a huge difference.
It is right.
Yeah.
Now, The Deficit Myth by Stephanie Kelton adds another layer.
Yeah.
Kelton argues that the U.S. government, as the issuer of its own currency,
Uh-huh.
doesn't need to find money to spend.
Okay. It just credits accounts.
Interesting.
Similar to how banks create money through lending.
I see the connection.
This challenges the widespread belief that government deficits are inherently bad.
Right. That's a common concern.
Kelton argues that sometimes
Yeah.
deficits are necessary to stimulate the economy and achieve policy goals.
So it's not always a bad thing.
Right.
Okay.
And think back to the historical example she uses.
Yeah.
When the U.S. paid off its national debt in 1835,
Okay.
a severe economic downturn followed.
Huh. That's counterintuitive.
It is, right.
Yeah.
So if deficits aren't the problem,
Right.
what is?
Yeah. Good question.
Well, Kelton highlights the concept of real resource constraints.
Okay.
It's not about how much money the government spends,
Okay.
but whether the economy has the resources,
Okay.
labor, materials, productive capacity.
To meet that demand.
Right.
I see.
When spending exceeds those real resources, that's when we see inflation.
Which is the real danger.
Okay.
And this is all starting to make more sense, right?
It is, yeah.
But what about the trade deficit?
Right, that's always in the news.
We always hear about it as if America is losing.
Yeah, losing to other countries.
Kelton argues that this is a misunderstanding.
Oh, interesting.
She uses the analogy of different buckets, representing the private sector, the government, and the foreign sector.
Like containers for money.
Exactly.
Right.
She's highlighting that trade deficits aren't about one country losing to another.
Okay.
It's more about the flow of money between these buckets. A trade deficit in certain scenarios can be the flip side of a government deficit.
Which, as we just discussed, can be a tool to stimulate the economy.
Exactly.
Okay, so it's more nuanced than just losing.
It's a lot to wrap your head around.
It is.
There are so many moving parts to this system.
Yeah, it's complex.
And it gets even more complex when we consider all the players beyond commercial banks.
Right, because it's not just them, is it?
Salimi introduces us to a whole range of financial intermediaries. Institutions that channel funds between savers and borrowers.
So like connecting the dots?
Exactly.
Give me some examples.
Think of thrift institutions, mutual funds, and even organizations like the Grameen Bank.
That's the one that provides microloans, right?
That's right.
Empowering people in developing countries.
Exactly.
Yeah, very cool.
These institutions all play a vital role in connecting those who have capital with those who need it.
It's like a big web.
It is a complex web.
Yeah.
And like any complex system, it comes with inherent risks.
Oh, right, of course.
Salimi highlights risk, uncertainty, and moral hazard as potential dangers.
Lurking within this financial system.
Yeah, exactly.
Okay, well, let's break those down.
Okay, so risk is the possibility of things not going as planned.
Right.
Uncertainty is the inherent unknowability of the future.
Makes sense.
These factors can lead to poor investment decisions, market bubbles,
and ultimately financial crises.
Exactly. Moral hazard is a different beast.
How so?
It arises when individuals or institutions are insulated from the consequences of their risky behavior, leading them to take on even more risk.
That's dangerous.
It is, and our unnamed source is particularly concerned about moral hazard.
Okay.
They argue that bailing out banks during crises creates this very problem.
Oh, right, because they know they'll be rescued.
Yeah.
Even if they make reckless decisions.
It's like giving them a free pass.
That's a valid concern.
And to understand how these risks can manifest in devastating ways, let's look at the 2008 subprime crisis.
Okay, that's a good example.
A perfect example. All right, so the 2008 subprime crisis.
Yeah, a good place to start.
Salimi explains subprime mortgages, those loans given to borrowers with less than ideal credit.
Risky borrowers.
Right. Were bundled together into complex financial instruments called collateralized debt obligations, or CDOs.
CDOs, yeah, I've heard of those.
And these CDOs were then sold as safe investments, which...
That doesn't sound good.
Not really.
Yeah.
Our unnamed source puts it. This was essentially funny money being pumped into the housing market.
Inflating a bubble.
Inflating a massive bubble.
Which is bound to burst eventually.
And they argue that this crisis was a ticking time bomb because the system itself encourages these cycles of boom and bust.
Yeah, that makes sense.
So when the housing bubble inevitably burst, defaults surged.
Right.
And the whole system came crashing down.
It all came tumbling down.
It exposed just how fragile and interconnected the financial world really is.
Everything's connected.
It is.
So how do we prevent something like this from happening again?
That's the big question, right? Like more regulations,
maybe
stricter lending practices.
Possibly.
What do you think?
Well,
Salimi discusses some regulatory responses, like the Dodd-Frank Act, which aimed to bring more transparency, oversight to the financial system.
More accountability.
Exactly.
Yeah.
But he also points out that these regulations often arise as reactions to crises.
That's true.
And they might not be enough to prevent future ones.
That's like a Band-Aid solution.
That's what our unnamed source says. They believe we need a complete separation between money creation and the activities of banking.
So like two completely separate things.
Exactly.
Okay.
They envision banks operating more like typical businesses, subject to the same market forces as any other companies.
Interesting.
Meanwhile, the creation of money would be managed by a separate entity, possibly a public institution.
A big change?
It is a radical idea.
Yeah.
I'm not sure I'm ready to embrace a full-blown financial revolution.
It's a lot to take in.
But I see their point about the concentration of power within the financial sector.
Right.
It is concerning.
Yeah, for sure.
And this is where Kelton's ideas about fiscal policy become particularly interesting.
Right.
What if we empowered the government to use its spending power more effectively? Perhaps then we could lessen our dependence on this potentially unstable financial system.
That's an interesting thought.
But wouldn't that shift the risk from banks to the government?
Possibly.
Couldn't that lead to rampant inflation?
Well, Kelton argues that the real risk of inflation stems from exceeding the economy's real resource constraints.
Okay.
Not just from government spending itself.
So it's more nuanced than that.
Right.
Okay.
She suggests that a job guarantee, by providing a buffer against unemployment and stabilizing wages, could actually help to keep inflation in check.
It's a thought-provoking argument.
It is.
But it definitely goes against the grain of what we usually hear from most politicians and economists.
It's a different perspective.
That's because the dominant narrative about money and deficits is often rooted in misleading analogies, like comparing government finances to a household budget.
Right, which isn't really accurate.
Kelton challenges these assumptions,
reminding
us that a currency-issuing government operates under a different set of rules.
It's its own beast.
It is, and I'm starting to see how deeply ingrained these misconceptions are.
Yeah.
How we think about the economy.
It's like we've been working with a faulty understanding.
It's almost as if we have of how money truly functions.
And those misconceptions have significant consequences.
Right, they do.
They limit our policy options, create unnecessary fear and anxiety, and can even prevent us from addressing crucial issues, poverty, inequality, and climate change.
Big issues.
Absolutely.
Okay, so if we're going to rethink the financial system, where do we start?
Good question.
What are some concrete steps we can take to move towards a more stable and equitable model?
That's the million-dollar question, isn't it?
It is.
While there are no easy answers, I think education plays a crucial role. Understanding how the system truly works, questioning the myths, and engaging in thoughtful discussions about the future we want to create.
Those are all important steps.
Absolutely.
It's like we need a whole new framework for thinking about money and the economy.
Yeah, we need a new lens.
What stands out to you from all of this?
You know, for me, the most impactful realization is that we have more power to shape our economic destiny than we often believe. Once we understand the true nature of money, its creation, and the forces that influence its value, we can start advocating for policies that put human well-being front and center. Instead of being limited by artificial constraints or outdated assumptions.
It's almost a feeling of empowerment.
It is empowering.
Recognizing that we're not just pawns in this game, but we can actually change the rules.
We have agency.
But what about our unnamed source?
Yeah, what do they think?
They seem pretty passionate.
Yeah, they do.
About the need for change.
What do they have to say about finding solutions?
Well, this particular transcript doesn't offer a specific blueprint for a new system. However, they do raise some provocative points about the role of financial speculation, the hazards of bailouts, and the need to democratize the process of money creation.
I would definitely favor a more radical approach.
They do, but how realistic is a complete overhaul of the system?
That's a big question.
What are the potential downsides and unintended consequences we need to consider?
That's a crucial point.
Right.
Any major systemic change inherently carries risks. We need to carefully weigh both the potential benefits and drawbacks before embarking on such a path.
It seems like finding a balance is key.
I think so.
Embracing innovation and new ideas while also proceeding with caution for acknowledging the complexity of the system we're dealing with.
Exactly. It's a delicate balance.
And that's where the importance of diverse perspectives comes in.
Absolutely.
We need to be open to different viewpoints, challenge our own assumptions, and engage in constructive dialogue to find the best path forward.
Couldn't agree more.
I'm starting to feel like we've just scratched the surface here.
Me too.
There's so much more to learn about this topic.
It's a deep rabbit hole.
It is. It's fascinating.
Yeah.
But before we wrap up this section,
okay.
Is there anything else from our sources that you think is especially important for our listener to consider?
I think it's worth emphasizing the historical examples that both Salimi and Kelton provide.
What do they tell us?
They remind us that our current financial system isn't some immutable law of nature. It's a human creation that has evolved over time.
Which means it can change.
Exactly. And those historical examples offer valuable lessons about the potential consequences of different policy choices. We can learn from the past, both its successes and its failures, to make more informed decisions about our economic future.
So to recap what we've covered so far.
Yeah, let's recap.
Money is a social agreement. Banks play a major role in its creation.
Right.
And the government doesn't need to find money to spend.
It just creates it.
We've talked about the risks of this system, particularly moral hazard, and the need to explore more stable and equitable alternatives.
Absolutely.
But now there's one more aspect we need to delve into.
All right.
Our unnamed source brings up this concept of financial imperialism.
Financial imperialism?
It's a term that can sound a
little intense.
Yeah, well, conspiracy theory-ish.
Yeah.
But I think it's worth unpacking.
Absolutely. It's a concept that requires careful consideration.
Especially within the context of the global financial system. All right, so this idea of financial imperialism.
It's a loaded term, for sure.
But I'm curious, how does it connect to what we've been discussing?
It raises questions about power, in the global financial system.
Okay.
Remember Salimi's discussion of the gold standard?
Oh, yeah.
Where countries tied their currencies to a fixed amount of gold.
Right.
It eventually collapsed, of course. But it highlights the power imbalances that can exist between nations.
And our unnamed source claims that the end of the gold standard ushered in this era of financial imperialism. What does that actually mean, though?
Essentially, they're arguing that countries with dominant currencies,
like
the United States, for example, they wield a disproportionate influence on the global economy. They can print more of their currency, which impacts exchange rates, and it can make it difficult for other countries to manage their own economies effectively.
So it's like a ripple effect.
Exactly.
One country's actions can send shockwaves throughout the world.
Yeah, and the unnamed source points to the 2008 financial crisis as a prime example. They argue that the crisis originating in the U.S. had devastating consequences for countries around the globe.
Even those with relatively healthy financial systems,
Exactly. It highlights the interconnectedness of the global financial system. But it also raises questions about fairness and accountability. When things go wrong on a global scale, who bears the cost?
It's like a giant game of financial hot potato.
That's a great analogy.
No one wants to be left holding the bag.
Exactly. It underscores the need for greater international cooperation and coordination, to manage this global financial system in a way that's more stable and equitable.
So what does that look like practically? More international regulations, a global currency.
That's a big one.
What do you think?
Salimi touches on this briefly when he discusses monetary policy coordination between central banks. He uses the example of the Federal Reserve working with the European Central Bank. During the 2008 crisis to try and stabilize things.
But that doesn't always go smoothly, does it?
No, not always.
Why not?
Countries often have competing interests. Different priorities, varying levels of trust in one another. Salimi uses the analogy of a prisoner's dilemma to illustrate the challenges. Imagine two suspects being interrogated separately. If they both stay silent, they both get a lighter sentence. But if one confesses, implicating the other, the confessor goes free, while the other gets a harsher sentence.
So they're incentivized to betray each other.
Exactly.
Even though cooperation would be the best outcome. Self-interest gets in the way.
Often, yeah.
And this is where the unnamed source's critique of financial imperialism becomes particularly relevant, right?
I think so.
They argue that the current system is inherently tilted in favor of powerful countries. And true cooperation is impossible without addressing those power imbalances. So it sounds like we need a major shift in the global power structure.
For sure.
But is that even remotely feasible?
It's a monumental challenge.
Yeah.
But I think the first step is acknowledging the problem.
Okay.
Having open conversations about it. Exploring alternative models for a more just and sustainable global financial system.
Are there any real-world examples of countries trying to break free from this financial imperialism?
Kelton points to some interesting cases. Argentina's decision to default on its foreign debt.
Wow.
And implement a job guarantee program during its financial crisis.
So they basically said, we're going to prioritize taking care of our people, even if it means defying the dictates of global financial markets.
Exactly. A bold move.
Did it work?
It's a complex situation.
Yeah.
The outcomes are still being debated, but it does demonstrate that charting an independent course is possible.
Okay.
Even for countries facing immense economic pressure.
It's inspiring to see countries pushing back against the status quo.
It is.
But let's bring it back to the individual level.
Okay.
What can we do as everyday citizens to navigate this complex financial system and contribute to a better future?
Kelton stresses the importance of education and political engagement.
Right.
She encourages us to understand how the system works, to challenge the myths that perpetuate inequality, and to advocate for policies that prioritize human well-being.
So it's not just about managing our own personal finances, but also about engaging with the larger systems that impact us all. And even our unnamed source, with their call for radical change, emphasizes the importance of individual action.
They do.
They urge us to become more aware of the issues, educate ourselves, and demand a more just and sustainable financial system.
Absolutely.
So what does this all mean?
Well,
it seems like we've come full circle.
In a way,
Money is a social contract, a powerful tool that can be used for good or for ill.
And ultimately, it's up to us to decide how we want to shape its future.
That's a great point.
It's been a fascinating discussion.
It really has. Thank you for joining us today for this deep dive.
My pleasure.
Into the world of money and banking.
It's a complex world.
It is, but we hope you've gained some valuable insights.
I hope so, too.
And are inspired to continue exploring this fascinating and ever-evolving subject.
Until next time.
See you then.